The room is dark, lit only by the glow of trading screens. Green and red candles flicker, casting stories of hope and despair. A trader sits, eyes fixed on the shifting numbers. Each tick up brings a quiet thrill. Each tick down, a jolt of anxiety. This is where fortunes are made and lost. But the real battle is internal. We arm ourselves with data and logic, convinced we can outthink the market. Yet, when money is on the line, emotion takes over. A primal force, loss aversion, begins to dictate our choices. The air grows heavy as a long red candle forms, profits vanish, plans dissolve. The trader's mind races, not with analysis but with fear and regret. He clings to hope, paralyzed by the prospect of loss. The greatest risk isn't the market, it's our own reaction to it. Success in trading is not just about analysis or timing. It's about mental fortitude and understanding our own irrational impulses. Before mastering the markets, we must master ourselves. The flickering screen is a mirror, reflecting our inner turmoil. Every trader faces this psychological gauntlet. The journey is not just about profit but about self-mastery. The market tests our discipline at every turn. Only those who recognize their own weaknesses can hope to prevail. The true challenge is not outsmarting the market but outsmarting ourselves. In the end, the battle is within. The force at play is loss aversion. Losing $100 hurts far more than gaining 100 feels good. This isn't weakness. It's hardwired into our brains. Our ancestors survived by avoiding threats, not chasing rewards. When we lose money, our brain reacts as if facing real danger. The amygdala triggers fear, pushing us toward rash decisions. Even a simple coin toss reveals this bias. Most people need to win twice as much as they risk losing to feel comfortable. This 2-to-1 ratio distorts every trading decision. A small win brings fleeting joy, a loss leaves a lasting scar. Traders often cut winners short, desperate to lock in gains. Worse, they let losers run, hoping to avoid the pain of realizing a loss. Loss aversion quietly sabotages our best-laid plans. Understanding this bias is the first step to overcoming it. Amos Tversky and I called this prospect theory. We don't judge outcomes by absolutes but by gains and losses from our starting point. The pain of loss is steeper than the pleasure of gain, an S-shaped curve. The first loss hurts most, each additional loss stings less. The same goes for gains. The first win excites, the next is less thrilling. This explains why we hate taking small losses. We'd rather risk a bigger loss than accept a small one now. In profit, we become risk-averse, cashing out early to avoid regret. In loss, we become risk-seeking, holding on or doubling down, hoping to break even. We ignore stop losses, rationalize dips, and gamble for a comeback. Our actions are driven by emotion, not logic. The paradox: we protect our feelings, not our capital. Recognizing this pattern is crucial for any trader. The market punishes those who can't break free from this cycle. Mastery begins with understanding our own value curve. Consider David, a seasoned trader with a solid plan. He bought a tech stock at 50, aiming for 70, stop loss at 45. The stock rose, then fell. Anxiety replaced satisfaction. As the price neared his stop loss, fear took over. Loss aversion whispered, selling now means admitting failure. He ignored his plan, hoping for a rebound. The stock plunged past 45, then 40, then 35. David held on, defending his ego instead of his capital. The small loss he could have taken grew into a devastating one. He finally sold at 22, losing more than half his investment. David's story is common intellect lost to emotion. The real enemy wasn't the market, but his own mind. Loss aversion turned a manageable setback into disaster. Emotional discipline, not intelligence, separates winners from losers. Every trader faces this ghost in the machine. The lesson: stick to your plan, not your pride. The market is ruthless to those who hesitate. Discipline is your only defense. Don't let emotion write your trading story. Sarah, a swing trader, faced a similar trap. She went long on oil, but a surprise announcement sent prices tumbling. Instead of cutting her loss, she doubled down, desperate to break even. Hope became her strategy, not analysis. The market kept falling and her losses multiplied. The need to get even overpowered her discipline. She ignored new data, focused only on erasing her mistake. The rebound never came, her capital was wiped out. Loss aversion turned a small setback into catastrophe. The market doesn't care about our need to recover. Only discipline can save us from hope's trap. Trading platforms are designed to exploit our weaknesses. Real-time data, flashing colors, and instant execution trigger emotional responses. Green numbers give dopamine hits, red numbers spark panic. The interface keeps us glued, making rational decisions harder. It's easy to act on impulse. No cooling off, no warnings. Social features amplify FOMO and herd behavior. These platforms profit from our activity, not our success. The environment is engineered for engagement, not discipline. Every feature nudges us toward emotional trading. Recognize the game. The system is not neutral. Protect yourself by understanding how you're being manipulated. The market is tough enough. Don't let the platform be your enemy too. Awareness is your first line of defense. Survival in this environment requires a mental shield. The foundation is a strict trading plan, crafted in calm, not chaos. Define your entry, profit target, and most importantly, your stop loss. The stop loss is non-negotiable. It's your circuit breaker. Place it as soon as you enter a trade. Automate discipline. Adherence to the plan is everything. Shift your mindset from being right to executing with discipline. Accept small losses as routine, not personal failure. Control your environment. Limit screen time. Avoid emotional triggers. Set your trade, automate exits, and step away. Let your plan, not your emotions, guide you. The less you watch, the less you'll react impulsively. Discipline is about how you interact with the market, not just what you do in it. Protect your rational self from your emotional self. This is the true edge in trading. Conquering loss aversion requires detachment. Your self-worth isn't tied to any single trade. Wins and losses are just data, not judgments of your ability. Focus on executing your strategy consistently, not on individual outcomes. Keep a trading journal. Record your plan, emotions, and results. Review: did you follow your rules? That's success. Manage risk. Never risk more than 1 to 2% per trade. Small controlled losses drain trades of emotional power. The goal is steady progress, not adrenaline-fueled wins. The best traders are patient, systematic, and detached. The market is a marathon. Conserve your capital and your energy. Detachment is the mark of a true professional. The trader's journey is an inward one. The real battleground is the mind, not the market. Charts reflect human psychology, hope, fear, and everything in between. Success demands self-awareness and systems to counter our flaws. Loss aversion never disappears, but we can learn to manage it. The key is a calm, pre-planned response, not a panicked reaction. The best traders feel fear, but execute their plan anyway. They accept uncertainty and focus on managing themselves. True control comes from mastering your response, not the market. The real edge is psychological, not informational. Patterns on the screen are patterns of behavior, especially your own. Consistent profitability is a process of self-mastery. Discipline, process, and self-understanding are the path. Mastering trading is mastering yourself. That victory is worth more than any single trade.
This was Beyond the Shadows. If you found yourself questioning the official version of history, subscribe. Share your theory in the comments. And remember, the truth is never where they say it is.